Hi, I'm Lucas from Quant Monitor. In this chapter, we'll look at swing trading patterns in a different way, not as chart shapes that magically work, but as cycle-driven behavior that repeats until conditions change. Swing trading patterns are often treated as visual shortcuts, recognizable shapes that promise repeatable outcomes. That perspective is convenient but incomplete. Patterns are not graphical artifacts. They are behavioral residues. They emerge because markets do not move continuously. They advance, pause, compress, expand, and reset. Each of these phases produces recurring reactions. What traders later label as patterns are simply visible expressions of cyclical crowd behavior. So if you want to understand swing patterns, you must first understand cycles, because patterns don't exist on their own. They are consequences of how participation expands and contracts through time. Why do swing patterns exist at all? Because participation is uneven. Capital does not enter and exit smoothly. It arrives in bursts, pauses to reassess, and then either reinforces the move or withdraws. Those pauses create swings. Swings create structure, and structure creates recognizable repetition. Swing patterns exist because trends are not linear, decisions are not synchronized, and conviction builds and dissipates gradually. A swing is not a technical formation. It is a temporary equilibrium between opposing forces. Now connect that to cycles. Every market cycle alternates between two states, movement and digestion. Impulse phases expand price rapidly. Consolidation phases absorb participation. Swing patterns form in the space between these phases, where uncertainty temporarily stabilizes price. These opportunity windows are not random. They appear when early participants reassess, late participants hesitate, and new information is partially, but not fully, absorbed. That's why swing trading patterns are time-bounded opportunities, not permanent structures. And one more important distinction: patterns represent compression, not balance. During compression, the crowd is not neutral, it's conflicted. Buyers and sellers are active, but neither side is willing to fully commit. That indecision stores potential energy. When compression resolves, price moves not because of a signal, but because the crowd finally aligns. Patterns are simply the visible footprint of that alignment process. Now we get to the most important idea in this chapter. A pattern can look the same, but while the cycle underneath it changes, that's why patterns repeat and why they eventually fail. Let's break it into cycle phases. 1. Accumulation-driven swing patterns. In early cycle phases, patterns look subtle and irregular. Volatility is low, participation is limited, price revisits the same area repeatedly. These patterns feel frustrating because they lack confirmation. But that's precisely their purpose. Accumulation-driven swings reflect cautious entry, gradual position building, and limited public interest. Patterns here rarely look clean. Their value is not precision, their value is persistence. 2. Expansion-driven swing patterns. As the cycle matures, patterns become more pronounced, volatility increases, price reacts more decisively, swings expand in both size and speed. This is where most traders believe patterns work best, and they do, temporarily. Expansion-driven patterns succeed because participation is increasing, reactions are quickly validated, and failure becomes obvious. But clarity is a double-edged sword. The more visible a pattern becomes, the closer it moves towards saturation. 3. Distribution-driven swing patterns. Late cycle patterns feel familiar, but they behave differently. Price still swings, but reactions weaken. Breakouts fail more often, swings shorten. Volatility becomes erratic rather than directional. This phase confuses traders because the shape remains, but the outcome changes. Distribution-driven patterns are deceptive. They mimic earlier phases while lacking the participation necessary for continuation. This is where pattern recognition without cycle awareness fails. So why do swing patterns fail? They do not fail randomly, they fail structurally. Failure occurs when the underlying cycle shifts, participation saturates, and the crowd's behavior changes. The pattern remains visible, but its meaning disappears. This is exactly why pattern libraries mislead. They preserve the form while discarding the context. What once represented opportunity becomes noise. Two final principles to anchor everything. First, swing patterns are scale invariant. They appear intraday, across days, and across weeks. The structure remains the same because human behavior remains the same. Only the time horizon changes. So understanding swing cycles is not about choosing the correct time frame. It's about recognizing where compression and expansion occur relative to the broader cycle. Second, pattern libraries are misleading. Pattern catalogs isolate form from cause. They teach recognition without explanation. Traders memorize shapes without understanding why those shapes appear or why they disappear. Patterns do not function independently. They are conditional. Without cycle awareness, recognition becomes superstition. So what is a swing pattern really? A swing pattern is not a trade. It is a situation. It describes the state of participation, the degree of compression, and the likelihood of expansion. Execution is a separate question. Treating patterns as signals collapses context into instruction. Treating patterns as context preserves flexibility. And this brings us to the conclusion. Cycles trade patterns, not traders. Swing patterns are consequences, not causes. They exist because cycles exist. They repeat because behavior repeats. They fail because conditions change. Traders who chase patterns trade shadows. Traders who understand cycles trade structure. Patterns will always appear on charts. Understanding why they appear is what separates repetition from comprehension.